Don and I had been talking about doing a webinar for retirement planning for quite a while. And so this is the first time that I'm going to do this particular presentation. And I think it's really important that, we all sort of look at and figure out what are we trying to accomplish here? Are we trying to go to college and then work for the next 30 or 40 years and then retire? Is that what our goals are here? Or is it something quite a bit different? Because, when I started out several years ago working, that was my goal. I'll work till I'm in my 60s and then I'll retire because that's simply what everybody else did. But that's not necessarily what I'm looking at when I'm talking about retirement, in the sense that I've heard people in their 20s say that that's what they're working for right now, and it's not the age 60s that they're looking for, but maybe 30s or 40s or something a lot more optimistic as far as the length of a work career goes. So. What I want to do tonight, though, and before I get into it, I want to mention the disclaimer, like Kendall mentioned before, but I'm not giving anybody here specific tax or legal or financial advice. I don't know anything about you. And if we were sitting in a big conference room, let's say we're in a big ballroom with 400 or 500 people there, I would say we have 400 or 500 different tax plans for everybody. So just know that I'm not specifically giving you legal advice, but these are some things that you may want to consider when you look at your overall financial plan or you look at your overall retirement and tax planning strategies. So let's look at where some of the things that I think we need to start with our retirement tax planning strategies. And I can't emphasize number one enough here. Start early with planning. The earlier you start at this, the longer you have to allow these gains to multiply, to compound. And so somebody starting their retirement at age, 15 or 20 is going to be in much better shape, typically, and all things being equal, as somebody that's going to be starting 30 or 40 years later. So the time value of money, the ability to take, whatever the investment is, let's say it's a $5,000 contribution to an IRA, and just see that double over time, multiple times. And so we get that benefit. And so the earlier we can start with our retirement planning, the better. And then, of course, we need to understand what our options are, what are our choices at each stage in life. And this is going to be a little bit different for everyone. So you may be in a situation where you're in your 20s and you're a W-2 employee, or maybe you're self-employed. Maybe you have your own S corp or a C corp or an LLC, or maybe you're doing investing as your means of support. Lots of different ways that you can be making the money, and how that money comes into you is going to dictate to a large extent what we can do with our retirement planning. We need to also understand, and that this becomes really quite important here, as far as our investments go, and what are the tax differences between a taxable account and a tax deferred account. And this is critical in the sense of how do taxes impact our investments all the time. So it's not just something where, we have to consider this when we're 65 years old and we're ready to pull out money from an IRA. No, we need to look at what type of investments we have today, and are they better for us in a taxable account rather than a tax deferred or a tax free account. So I'll be talking about different investments and where those are going to be best played and best made at the end of this presentation. As far as retirement goes, when you're getting distributions, and this could be something where you can take a retirement distribution from a Roth or a traditional IRA or 401k when you're in your 30s. Now, I'm not necessarily recommending that you do that, but no matter when you are taking that, you must understand how this is going to be taxed before you take the distribution. Okay, because once you take it, it's kind of set. So as I was mentioning here, we're going to start early with this. Okay, so the sooner you can start, the better. And so I've had clients where maybe they have using pictures of a little, their daughter or something when she was 1 year old in their advertising. And so guess what? That 1 year old then would have some earned income here that they were going to have to file a tax return for, whatever they made as far as the income goes. So as long as we have something where it's earned income, it's not investment based, but it's based on our working here at some sort of a job, we can contribute to a retirement plan. And the younger we are, the more we want to consider a Roth IRA as the investment vehicle for the retirement plan. Now, there's so many different types of retirement plans, and I'm going to hit on a bunch of them tonight. And I've even had different webinars where we've gone over here's the 401ks and the Roth 401ks and the SEP plans and the simple plans. So all of these are up there as far as the Protect Wealth webinars go. So go look at the archive, and you can find out a lot of this information that's already up there. But I mentioned before as well, tax-free versus tax-deferred accounts. I'm going to be talking about that a lot because this Roth version of an IRA or a 401k is to me probably the most attractive retirement plan vehicle that you can have today. As far as what a lot of people can qualify for it, it applies to a lot of different situations, and it gives us the opportunity to have a lot of income at our disposal when we retire that is tax free, not tax deferred where we're just going to pay it down the road, but here we're never going to pay it. So think about if you could make an investment and put $1,000 into a Roth IRA and it turns into $1 million for whatever reason. You invested in a brand new Amazon or Google or something, Microsoft or something, and you make this huge amount of money. All of those investment gains will never be taxed. And you can pull that money out and use it for whatever you want to use it for. So, okay, so let's look at this. So I'm a 16-year-old and I make a one-time $7,000 contribution to a retirement plan. And over here we've got this little $7,000 challenge, 35 $200 contributions. But how many 16-year-olds, first of all, are making more money than this? And how many of them want to spend the money on an IRA that they're going to get, 50 years from now? Not many. But let's say that we have this 16-year-old that goes out and this person makes at least 7 grand. We can then gift the contribution to that person and make the contribution that way. So let's say again, goes out, earns $10,000. I could gift the $7,000 to him, make the contribution, and makes that one-time contribution 7% annual return and goes to age 65. You can see where this is going, right? That over time, over 5 years, well, we come up with a couple grand more. Then we're at 9 years and we're doing pretty well, but then it starts compounding. And so this one $7,000 contribution, when this particular person goes to retire, is going to be worth $192,000 with these assumptions in play. Now, that's a huge amount of money because we didn't factor in taxes. And so if we did the same investment, the same 7 grand at 16, getting the same annual return, but we've got to pay taxes. So it's not in an IRA, it's in some sort of a taxable account. We still are doing pretty well, right? By age 65, we're still going to have a six-figure account, even after we pay taxes every single year, right? When I'm 17, I pay taxes. When I'm 18, when I'm 19, and all of these 40 to 50 some years here, I'm paying taxes. And so at the end of it, without having a retirement tax strategy in place, the IRS is saying, thank you. You know, whatever language you want to put in play here, the IRS is saying thank you because this is what the IRS got as a result of you making that investment in a taxable account. The IRS gets 91 grand, and if we go back to the last slide, you get 101 grand. Or we go back to the slide where we have it in a retirement account, and now the IRS gets none of this. Okay, all of these earnings, all up to this point, have been tax deferred. Okay, meaning we don't pay taxes until we take it out. Okay, and that's where the big reconciliation is going to come from, is when we take it out. Because let's look at it here as a single distribution. So I'm age 65 and I've got that money in the account. You know, that $7,000 has now gone to this $192,000 amount. I pull it out. Well, in my taxable account, I get to pull out this amount. I've paid taxes all these years. So whatever's in the account, 101,072, I get to take out. Okay, great. The tax deferred is where I get hit because if this was in a Roth, I would keep all of the 192,000. But since it's not, it's going to get taxed when I pull it out if it's tax deferred. So that's the three possibilities here of what that $7,000 investment could be worth, with the difference again in the values solely the result of taxes. So same exact investment, same strategies, and whatever your plan was of buying stocks or bonds or having it in cash or whatever you decided to do, this is what taxes will do to the investment. So you need to be aware that taxes are going to be paid obviously in taxable accounts. In tax deferred accounts, we're just delaying the inevitable. And in tax free accounts, what we're doing is we're paying the taxes up front. So if I have $10,000 in income, I may pay 2 grand in tax on that. And with that, after I've paid the tax, I can put the money into a Roth account. So I'm already paying the taxes up front. So everything that I make in the future is going to be tax free. And in my opinion, the best of all possible worlds. Now, as far as the planning goes here, I get conservative when we're talking about retirement planning, in the sense that this is the money that you're going to use when you're no longer working or when you no longer have your business or whatever. So you want to make sure that you're being conservative in the sense of, you don't want to take huge risks with it. You want to safeguard, all of these assets over here and enjoy the tax benefits. And by planning today, by planning when you have your first job, whether that's a teenager or whether you're in your 20s or maybe you didn't know about any of this stuff and now you're in your 30s, get started now. Sooner is better than later. As far as the plans themselves go, contribute as much as you possibly can to any employer plan that you have. Okay, so let's say that you're employed by Microsoft and they have a 401k plan. Contribute as much of it, of much as possible to that plan as you can. And I'll give you some of the corporate contribution rates and percentages and stuff so you know what that is. But a lot of times we're looking at 25%, up to 25% of your W-2 wages. Even if you can't do that, let's say that you're really not making enough money or you're paycheck to paycheck, or maybe you're just saving a little bit of it, if you can contribute at least as much as what your employer is doing to match it, that is going to be our minimum. So if I'm in a situation where my company's going to match 3 or 4 or 5% of my wages, if I put the money in, let's go ahead and do that because it's free money. When we're talking about these retirement plans, the 401ks or 403bs or SEPs or simples or all these different types of plans, know that you can contribute to an IRA in the same year that you contribute to whatever the retirement plan is at work. So let's say you max out your 401k at work, you can also max out a contribution to an IRA. This is after we want to make sure we have an emergency fund. And I also throw in these health savings accounts in this retirement talk. Now, why do I do that? Because you can use health savings accounts to basically have another slush fund for retirement, and you can contribute the maximum to it. And I'll talk about this in a minute. Certainly not going to get into other retirement tax strategies and financial strategies, but certainly life insurance and all types of insurance come into play here. So I'd be remiss if I didn't mention that insurance definitely is going to come into play. Same thing with Social Security payments. So the timing of these, how soon do you want to take them, and will these be taxed? Understand how taxes are going to happen once you're retired, and understand these different age requirements. So there's these different catch-up provisions that allow people that are getting up in age, whether it happens to be 50 or 55, or you get up to these 59 and a half, 65, and there's ages in the 70s. So there's all these different ages that come into play with taxes and retirement. And we want to make sure that we understand and take advantage of all the provisions of, catch-up provisions, or when we have to start taking distributions and how much they need to be and what have you. So let's start here with the HSA. And what a health savings account is basically you have a high deductible, out of pocket, medical plan, health insurance, and now you can contribute up to one of these two numbers. If you're single, 4,300, and if you have two or more in the family coverage, $8,550. This is what we call a triple tax benefit plan. The triple meaning that number one, you get a tax deduction for this, or your business does. So if my business puts in, or I put in this 8550 this year, I get a tax deduction for it. It goes into now an account that all of the earnings are tax deferred. Okay, so if I put this in and I don't use it, and then in 2026, maybe this is worth 10,000 now. And I just keep going until the future here. At some point here, it becomes tax free. And that is when I use it for medical expenses. So when I use it for qualified medical expenses here, it becomes tax free to me when I take it out. So there's lots of different planning opportunities that we can do with these HSAs, these health savings accounts. So they're tax free when they're medical expenses. What if they're not, though? Well, if we take it out before we're age 65, it's subject to income tax. So if we take out 5 grand, we're going to pay tax on that 5 grand, and we're going to get this 20% penalty. So we take out 5 grand, we pay tax on it, and we pay $1,000 penalty. After age 65, it's taxed as income, but no penalty. So think about it. If you've been funding this for multiple years, you never took it out for medical expenses, you could take it out for medical expenses at age 65, or you could just take it out as income, like an IRA, tax it, that's fine, but you won't incur a penalty. So to get the triple tax benefits, you need to take it out for medical purposes, but you've got planning with this once you hit age 65 as well. I also want to mention here now, when we look at the employer plans, there's two possibilities as far as what employers are going to offer. And the defined benefit is the rarity. This is a pension plan. And so what this is the employer is going to say, after you've worked a certain number of years, we're going to provide you with guaranteed income for life when you retire. And they set the age. So at age 65, we're going to guarantee that you get $50,000 a year as long as you live. You need to get actuaries involved. There's a lot more math involved in this than there is in simply like a 401k plan, and much more expensive for the employer to maintain. Now, you can get a lot more put into it. So in business, you're the only employee. Maybe we look at something like this in a defined benefit plan. But for most businesses, and certainly those with employees, we're really going to look at the defined contribution plan. So instead of defining what the employee is going to get when they retire, that 50 grand a year for the rest of their lives here, um, basically, then what we're looking at is defined contribution. How much can we put in? So we get these pre-tax payroll deductions here for our 401ks or our SEPs or whatever. Company may match it, can set limits on it or whatever. But here, we don't know what we're going to end up with. We know what we can put in, but what we end up with at the end of the however many years we have before we want to start pulling it out is going to be based upon how good our investments were in the 401k plan, right? Or whatever the retirement plan is. So you can see the big differences here that we get higher contributions from the employers. The employer is really controlling pretty much the whole thing here. And so they determine as the employer how much they're going to contribute, what the salary is based on year of service. The employer is going to choose the investments. Whereas over here on the defined contributions on our 401ks and the stuff that we're really used to, we have a lot more control, but we don't know what we're going to have at the end. And so that's where the real key part comes. And I think you can see here that, like this slide is showing, there are a lot of moving parts here, a real lot of moving parts. And so what we're trying to balance here is income coming in from all these different places, hopefully, right? We may still have some business income. We may have some real estate investments. We may be in the stock market. We may have currently taxable accounts. We may have retirement accounts. We may have Social Security. We may have pensions, annuities. All of this stuff can come into play, and we need to know how is it going to be taxed and how can we keep the most amount of the money without having to give it all to the IRS. So let's look at some of these plans. As far as the IRAs go, again, I'm a huge, huge proponent of the Roth IRAs. I love these plans because they allow all of the investment earnings to grow tax free. Now, if you don't qualify for the Roth IRA because you make too much money or whatever, then we can certainly look at a traditional IRA, and sometimes it's deductible and sometimes it's not. But either way, we're talking about a relatively small tax deduction here, whereas the Roth IRA, as I mentioned before, we pay the taxes up front. So we're contributing to the Roth IRA with after tax dollars and not tax deductible. So if we put 7 grand into a Roth, we do not get a tax deduction for that this year. But we can get tax-free distributions. Okay, and that's where this age 59 and a half comes in, or at least 5 years after the contribution. Um, and the other thing I want to mention is no RMDs. So you never have to take money out of it. No required minimum distributions. That'll become real big when you have traditional IRAs because these do have required minimum distributions, depending on your age. So if you're born in 1960 or sometime thereafter, you've got to start taking distributions out of your IRAs, not the Roth, but the traditional ones at age 75. And if you're born in 1959 or before, it's at age 73. So maybe tax deductible, but again, I'm not as big of a proponent of these just simply because we're not going to get necessarily the tax-free part that we would with the Roth. So Let's look at example one here. And we've got Marge contributing for the previous 20 years to an IRA, and sometimes these were 4,000, 5,000, 6,000, whatever the maximum was or whatever. But she put 100,000 bucks into her IRA. She never deducted it, and the account is now worth 400,000. We need to understand our basis in this. Okay, what did Marge put in? Because if she didn't deduct it when she put it in, she gets to deduct it when she takes it out. And that's really key. So in this particular case, she puts 100 grand in, it makes 300,000, and now it's worth 400,000. We know right now that 25% of her value, 25% of this amount, is what she put in, and 75% is what the account earned on a tax deferred basis. So when she takes this out, so let's say she takes out $100, $75 is taxable, but $25 is a return of her basis. So that's if she didn't claim a tax deduction when she made the contributions. If she did, and so let's say she claimed a tax deduction here back all these years. Now her basis would be worth zero. And all of the 400,000 is these are the rules for IRAs when this money out. And we also need to be aware of the rules for employer plans. So these are your 401ks and the 403bs if you work for a nonprofit or some of the governmental agencies, and our SEPs and our simples. And you can talk to a financial advisor about, which one of these is appropriate for your business. And given, you have to look at the number of employees because you can't discriminate here, and figure out which one is going to give you kind of the most bang for the buck. Which one's going to produce the best plan for you and for your employees, because it's a big retention tool, certainly for your employees. Now, I want to throw out an age issue here of age 50, because once you hit age 50, you now can consider these what are called catch-up contributions. What catch-up contributions are basically taking the base amount, the maximum that, let's say, somebody who's 35 years old can contribute to a 401k, and we're going to give somebody that's age 50 and older an opportunity to put more in because maybe they didn't put enough in their first 25 years of working, and now they need to catch up. We also want to look at potential conversions to a Roth IRA. Now, I'd be looking at these in all ages, but I really be looking at these once, certainly if I haven't done so before, when I hit age 50, because at some point in the near future, a couple decades, I guess, I'm going to have to start taking these required minimum distributions. If I convert my IRA, traditional IRA, to a Roth, and the Roth doesn't have to take required minimum distributions, that means that this amount will go down in retirement, and so will my taxable income. So this is something that I think everybody should look at as far as converting to a Roth. But certainly when you get up to age 50 and now you've got to start taking retirement a little bit more seriously, then you'd be looking at the conversions. Now the catch-up conversions you can see are fairly substantial. So where I can put 7,000 into an IRA, if I'm, let's say, 45, I can now do 8 grand. Or the 401k plan, look at that, gives you an extra $7,500. I do want to point out the second bullet point in that the SEP plans do not have catch-up contribution provisions. So if you're over 50 and you've got a SEP plan, you can only contribute the maximum that anybody can contribute. There's no catch-up provisions. Mentioned the required minimum distributions, as far as depending on when you're born, before age 60 or before 1960 rather, or born in 60 or thereafter. But again, the more money you have in a Roth IRA, means the less that you're going to have as an RMD. And these RMDs are taxable because they're coming out of a traditional IRA. So you can always take more than whatever the minimum is. So if the minimum is determined that you've got to take $30,000 a year out, you can always take 40,000 or 100,000 or something more, but you've got to take out the minimum. And you'll see a lot of the financial companies or Schwab or companies like that, they'll compute this for you because you have to start looking at all of your different retirement plans, all of your IRAs to determine what these RMDs are. Now, I mentioned the Roth IRA conversions. These are um, taxable items here. And so they're taxed as ordinary income in the year of conversion. So you don't want to be doing this when your tax rate is 37% or something high. But if you've got a really low tax rate, it's 10% or 12%, or you estimate, your future tax situation that I'm in 20% now, but I'm going to be 37% next year. Maybe we pull this in now when our tax rate is low. So this is an individual choice and it can vary by the year. So I've had a lot of clients where their income goes up and down quite a bit every year. So when they're in a low year, they convert. When they make a lot of money, they don't. All right, so let's look now at some of the income buckets in retirement. Social Security, taxable income during retirement. So the big beautiful bill and whatever President Trump was saying that seniors won't get taxed on their Social Security. That's not true. You will get taxed on your Social Security, just less of it. And so you could see these numbers are 23,750, and we go ahead and double that. And so we're looking at the senior deduction. So we get a standard deduction. We already had this deduction, but the one big beautiful bill added in this $6,000 extra deduction here. And they doubled that for married seniors. Now you'll notice that this amount, this 46 grand, isn't quite double what this is because the existing senior deduction is 3,200 for two and only 2 grand for one. But anyways, this applies when you're 65 or older by the end of the year. And it phases out. And this is the part that people don't tell you. So yes, you may be able to get that full amount as long as your income is under 75 grand, or we can double that if you happen to be married filing joint. And then it'll completely phase out when we add $100,000 to these amounts. So if you're married and you make more than 250, or you're single and you make more than 175, you will not get the senior citizen bonus deduction. I also mentioned that Social Security can be taxed. So we have to look at what your combined income is. Now, most of us have never even heard of combined income. Yeah, taxable income or gross income or all these other things, but what's combined income? Well, I'll tell you what it is in a minute. But if your combined income and you're single here, your combined income is up to 25K, you don't pay tax on your Social Security. We look now, this little 9,000 here, dollar amount, up to 50% of the benefits can be taxed. And if you have more than 34,000 of combined income, up to 85% of your benefits can be taxed. Okay, so that is the general rule here. And for most of the retirees, they are not going to be in this position. And I'm glad because I want to see you have more income. If you're, trying to retire and live off of 20,000 a year of combined income, that's going to be a tough battle to fight here. So this is as if your single joint return gets a little bit more favorable. We don't double it, but again, this combined income guy is used, no tax, 50%, and if it's over 44 grand, 85% of the Social Security benefits can be taxed. So, what's combined income? Well, we add three things together. Number one, what's your adjusted gross income? So add all that up. If you get pensions, you got 401ks, you got IRA distributions, whatever. Add to that any non-taxable interest. So if you've got municipal bond interest or something where you're not paying income tax on, you've got to add that back in. And number three, one half of your Social Security benefits. So what does this all mean? Well, I think, I think the best way to go through this is to go through, uh, go through a couple of examples here. And here we have Maddie, who's 67, so she's retired. She receives 28 grand from Social Security, Security, 9,000 from interest, so she's got some bank interest, money markets, whatever, and she takes a $25,000 distribution from her IRA. So we add these two up, 25 and 9, and we come up with 34,000 of adjusted gross income. She didn't have any municipal bonds, so that's zero. And we know it's half of her Social Security, so that's 14,000. So now we know her combined income is, for purposes of Social Security, is 48,000. And so we know now that it's more than the 34,000. So now we know Maddie's Social Security is going to be taxed up to 85% or 23,800. So when we go to do her taxes, this 23,800 is what she's going to be taxed on. And the question, does she owe income tax? And yeah, unfortunately, the answer is yes, because her Social Security benefits plus her interest income plus her IRA distribution gives her all of her adjusted gross income. We still get the benefit of the senior deduction. We take that full amount, and she has this 34 grand of taxable income where she owes almost 4,000 bucks, about 11% rate of or tax rate on her taxable income. So yes, she will pay tax on it. Now, you want to consider that part of the Social Security or otherwise, it's up to you, but Maddie's going to owe tax on this. So you need to be aware of when you're going to start claiming because you can start at age 62, but simply because you can doesn't mean you should. And the benefits will increase for each year that you wait. So you want to use some strategy here, get your financial planner involved. And if you're married, strategize with your spouse. Maybe one claims and the other one doesn't. But this is something that can make a big difference as far as your overall financial situation. When do you claim, and how much are you going to claim, and how much is going to be taxed? Now, I mentioned the 401s, the 403Bs, 457s. You've got all these different plans here, but this is the column to take a look at, the 2025 limit. So yeah, it went up a little bit over last year, but these are the real big ones here. The catch-up contributions here for the 401ks and the 403Bs. Look at how much they can put in here as far as their salaries go. So you can, in theory, be able to contribute in a maximum here with your employer contribution, receive up to $81,000 of a tax deferred benefit. And these can actually be Roth accounts too, as far as the Roth 401ks. So it is possible to have a Roth 401k down here. But again, these are the limits, and you can always put in less. So if you've got a 401k plan and you can only afford to put in $1,000, put the $1,000 in. If you can afford to put in 50,000, well, you may be capped out of here with this 23,500 limit. But again, there's lots of ways that you can be creative with the amount of money that you can put in. Okay, so I want to spend the next few minutes here just looking at a couple of really quick examples, just so you can see how this plays in. So here we have Amy, 16 years old, has a W-2 job, local restaurant, makes 3,500 bucks, no retirement plan at the restaurant. Okay, pretty straightforward. She gets a W-2. She can contribute up to $3,500 because that's earned income to her Roth IRA or a traditional one. Now, I'd love to see her put it in the Roth because when she files her tax return, she won't owe any tax on this. She'll be able to exclude it all from income tax. So the Roth becomes really the ideal plan. And again, the parents, grandparents, somebody could gift her $3,500 to put in the account. And that's totally legit as far as the amount goes and the Roth goes. So she puts in this one-time investment of 3,500 bucks. And again, we're going to use this 7% annual return. She doesn't do anything else with it. That 3,500 goes up to almost $100,000 when she retires at age 65. Okay. Now let's add some years. Let's give Amy 10 more years. So she's now 26, starts a job at a local business, makes 60 grand, and her employer offers a 401k plan with a 3% match. Okay, so these 3% matches are pretty common. So they'll take 3% of her 60,000 or 1,800 bucks here, and they'll match it. They'll take that $1,800 and they'll dump it into a 401k plan for her. Be able to always get the benefit of that because that's free money from the employer. Now, she can now contribute up to 25% of her compensation or up to 15 grand to the 401k plan. And she can also contribute up to 7,000 to an IRA. Again, I like the Roth. That's why you see it in red, but it could be the traditional as well. So she's got multiple options here. Now, I want to keep going with this to show you again. So now she lets it go for whatever, 39 years. That one contribution has now gone up more than 10 times. Okay, so we're at now $333,000. This is the value of the compounding over time. And as this cartoon shows us here, not paying taxes while we're making the money. Now, we may have to take it or pay the taxes when we take the distribution here. I guess here, the pizza to go, we're taking our distribution from the IRA, so we're going to pay the taxes. But all along, taxes were not in play. All right, let's move ahead to the next one. And that is now Amy's getting closer to retirement. She's 56. She's been working 30 years at this local business. She earns a nice chunk of money on her W-2. Again, same 401k, same 3% match. Okay, of course, the 3% match on the 260 is going to be considerably higher, the $7,800. But look what she can put in here. She could put in potentially 23.5 and her employer does the 3% match. She could also put in 7 grand to a Roth. She could make this catch-up contribution of $7,500 into this 401k plan and another grand to the 7,000 into the IRA. So she can put away a huge amount of money, 46,800 as it turns out in this example. Now, notice this doesn't do a lot because we're only dealing with age 56 through 65. So we don't have that same time value that we had when Amy was 16 or 26. But still, worthwhile to add it certainly to any accounts that you may already be accumulating. All right, now I want to end the presentation tonight with looking at examples of how the money comes out. So now Amy's 65 and she's now receiving Social Security, 27.66 a month. I looked up some of what her benefits would be, and so she gets this $33,000. No other income, no RMDs, so that's all she has. $33,000, we know up to 50% of her benefits, because it's under 34 grand, can be taxed. So we know that she could be taxed on the 16,000, but with the senior deductions and the standard deduction, she zeroes it out and pays no tax. Now, let's take a look at what happens here when she is starting to add other things in. So we're still going to keep her age the same. So she still gets the same Social Security benefits, this 33,000, but now she takes a 401k distribution of 40 grand. And that's going to be taxable unless it's a Roth 401k. So in this case, it isn't. So we know now that up to 85% of her benefits can be taxed because of the combined income again. So now we know here's her tax amount plus her $40,000 distribution. She still gets the senior discount here, the deductions, right? But she's got taxable income and she will pay tax. Now we minimized it. She's paying a little bit less than 12% rate of tax, but still tax planning needs to come in because in this example, I just keep adding just a little bit more chunks of money just so you can see where Amy is getting the money and how it's taxed. Again, same Social Security benefits, and she gets 3 grand of interest, and she takes a taxable distribution of 40,000 from her 401k. Okay, all good. But she's got stock in Microsoft that she sold in her IRA. She's had it for a long time, and she gets this huge capital gain. And then she decides, wow, I made $500,000. I'm going to take it all and spend it this year. And so she takes a $500,000 distribution from her IRA. Look what happens here. This long-term capital gain in her IRA now goes to ordinary income. It's not taxed as a long-term capital gain when it's taken out of the IRA. So now we know her Social Security is going to get taxed. The 3 grand and the 40 grand get taxed, but this 500 grand gets taxed as ordinary income. So she doesn't get the 15% or 20% tax rate. Instead, she's paying 29% tax. So this is a situation where she needed counsel before she did this. Don't take out the 500,000 or take out something less, or we'll structure it different ways, or these are your deductions. Maybe you can itemize your deductions, give to charity, or do something to where this taxable income is not over $500,000. But again, we have options here as far as when we can do um, certain things, as far as when we can take the money. So here's what I want to leave you with as far as, I guess, some of my final thoughts. And I'll turn it back over to Kendall here in a minute. Um, but we have to understand our future tax rate risk. Do you think that your taxes are going to be at a high rate in the future or at a low rate? And that's really, really hard to do. Even if you're 65 right now and you're not going to take the money out for 2 or 3 years, I have no idea what the tax rates are going to be in 2 or 3 years. So, you have to try to consider this and say, well, I'm going to be in a high bracket, therefore making the Roth IRAs a lot more beneficial, or I think I'm going to be in a really low bracket. I'm not going to have much money when I retire, and that gives you, I guess, a lot more structure and a lot more flexibility. Maximize Social Security benefits and the timing. So, do you take it out at 62, age 65? Do you wait to age 70? And when you do look at your Social Security benefits, you want to align these with your IRA distributions, with your RMDs, with your 401k plans. Because again, the whole purpose of the tax planning, is to make sure that your retirement is secure, right? That you don't run out of money. And so by paying less in tax today, maybe you will pay some tax down the road, but you'll have more money down the road. We also want to look at what our lifestyle is going to be. So you may have a very high lifestyle or a very low lifestyle as far as financial capabilities are concerned. So you want to look at what kind of distributions are going to be needed to support that. Make sure you are thinking about taxes and you maximize the order of taking the distributions. So maybe you don't take from the Roth because the Roth isn't going to have to pay taxes. So you can just keep watching that going up and up and up and up while your traditional IRA that you have to take RMDs goes up, and then you take a distribution, then it goes up, and then you take a distribution. And so you may want to be looking at what is going to be beneficial between the Roth and the traditional IRAs. So you look at How will they be taxed? If the assets are going to generate ordinary income, it's going to be taxed as your bracket or whatever. Yeah, let's look at a tax deferred account or one of these Roth accounts. And if we're going to get a long-term capital gain, well, maybe that Microsoft stock would have been better being held in a taxable account. So, we don't always want to avoid taxes up front. So if we've got stocks or some equities that are paying dividends, these qualified dividends can be taxed at 15%. These long-term capital gains, again, these can be taxed at 15%. Maybe we don't pay anything on our muni bonds, and our real estate with depreciation and all the other tax benefits can really work well in a taxable account. Now, that's not to say you don't want real estate in a IRA. You can certainly do that, but understand that the tax benefits fit really well within a taxable account, especially if you qualify as a real estate pro. But we look now too at any of these tax-free Roth accounts or tax deferred. We want the ordinary interest. So whatever the ordinary income is going to be, that's what's going to be best in the tax deferred accounts. So these taxable bonds or annuities, or we're holding short-term equities. Let's say I want to buy and sell stocks in a month or hold it for 2 months or anything less than a year. Maybe non-dividend paying equities, right? That these ones are, growth stocks or REITs here, these real estate investment trusts when everything is taxed as ordinary income. This is where it's going to be most beneficial, and you've got to figure out what's going to be the best way to allocate this. And that I think is the really hard part. So I'm going to leave you here with this, my presentation with this quote from Albert Einstein. Kendall knows I use this guy a lot, but if he can't figure out the income tax, how are we supposed to be able to? But hopefully, this sort of gave us like a little bit of a plan, a little bit of structure to say, okay, this is how I'm going to save for retirement, and this is how I'm going to maximize my tax benefits while I'm doing so. And when I retire, I'm also going to do so in a tax advantageous way. So hopefully it gave everybody, a few ideas here tonight, Kendall, and don't know if we have any questions or whatever, but
We
I
do.
probably went a couple minutes over what I wanted to do, but anyways, thank you.
Thank you, Scott. No, that's beautiful. Fantastic advice. Thank you so much. As you can tell, everybody, this is why we love Scott Estill so much because this information is gold. And frankly, one of the things that we really love Scott for, but it's really one of the things we try to cover at our Asset Protection Summit. Scott, I did just put that in the chat screen. These are the strategies that are super important. And one of the things, Scott, you know better than me, and I'm sure as a asset protection tax attorney, planning is everything. It really is. Tax preparation versus tax planning. One is reactive rather than proactive. And I can tell you, this is me personally, my experience. Don will say the same thing. You probably will too. But everybody who plans does far better than those who don't, right? You fail to plan, you plan to fail, as they say. And so we love, especially these strategies, Scott. You do have to have a plan. It just takes time. And a lot of us are so busy, we don't do it, me included. But thank you so much, Scott. Beautiful.
Absolutely. Absolutely. I think I mean, you hit the nail on the head there, right? As far as you've got to have a plan here, and it doesn't, you don't have to be Bill Gates or some, multi-billionaire to have that. I mean, we all need some sort of a tax plan here, and that's why I've always enjoyed the 3-day events. I probably don't sit through every single presentation of every 3-day event, but I pick up so many unique things, and the laws are changing, investment strategies change. Your asset protection strategies may be changing depending on new court cases. So to me, it's always valuable to attend the 3 days just to make sure that I'm up to date on, what's happening now and not what happened 20 years ago.
Yeah, and even you and me, Scott, I know we've taken advantage of a lot of things and strategies on the summits because it's kind of like that third mind, right? All of us together create that third mind that's beautiful. You don't get anywhere else. And that's what I love about doing what we do, being with people like you, Clint Coons, Don, all the experts. And it really is kind of incredible. Thank you so much, Scott. If it's okay, we'll do a few minutes of questions. I know we don't have a ton of time tonight, but we'll do our best to get through as many as we can. But maybe not all of them, but we'll do our best. All right, Scott, are you okay if I ask him and then we'll just go ahead and answer as we go?
Yeah, yeah, I'm fine with that. I think, we'll keep it to, let's say, 15 minutes of question
Great.
and answer. And then, I think that's one of the other things too, before we get into it, is that, the 3 days
Yeah.
gives the students or the attendees, all of us, an opportunity to get those questions answered. I think that
Yeah, that
that
is
to me
true.
is really, really valuable.
Yeah, we do our best to have experts on in the background answering questions. If you have specifics, that's why we do it. So please come register there, protectwealth.com / live dash events. So really that link in the chat there, or protectwealth.com has the link directly. We would love to have you. There are experts in the background answering questions. So please come. Again, it's free and it's on live stream on Zoom. So come
Mhm.
check it out. If you can't make it on those days, we have other dates available. But sometimes, even on your lunch break or something, come check it out and then come back later. It's a totally fine. We're okay with that. Life is busy. All right, Jen's asking, can I convert a tax deferred IRA to a Roth IRA?
Yes, absolutely. You can do that, but it's taxable. That's our problem here, is that you want to do it in a year where your tax rate isn't super high on that. But yes, absolutely, you can do that.
Okay, probably some planning there. Okay, Teresa, what about beneficiary who inherited Roth and IRA?
Well, if you inherit an IRA, it's treated a little bit different than if you contribute to one. But if you inherit the Roth IRA, again, you're not going to pay taxes when you take that money out. If you inherit a traditional IRA, there will, or very likely will be taxes due on that. And you definitely want to look at some financial planning there, as far
Interesting.
as inheritance go.
Okay. All right, this is a great planning question. Linda says, is it better for me to plan to use my Roth investments if I need money in the future for my grands to inherit my brokerage cash, or reverse, use my brokerage if I need money to set up my Roth for inheritance and grandkids? And I plan to live another 40 years after retirement. That's hard to say. That's definitely a planning question, right, Scott?
Yeah, well, yeah, you're when you get into the planning, and again, I don't give you, financial advice as far as what you should be buying or selling or whatever, but anytime you can contribute to a Roth, versus some other taxable account, I think you have to look at the Roth option and take out of other accounts first, because the Roth account, whether it's an IRA or 401k, that's all tax-free income that you're generating there. So if you can make millions in that account, why not do it? Because it's never going to be taxed. Whereas take the distributions out of things that are going to generate other tax bills.
Kind of cool. Yeah, it's definitely a planning thing. Think it through. Great question. Sajid, do withdrawal from Roth IRA count as income during retirement?
If it's a withdrawal from a Roth IRA, no. From a Roth 401k, no. But from a regular 401k, yes, on that one. Good question,
Great.
because that's the whole game right there, and you just definitely nailed it.
Yeah, that's cool. Got to think that one through. Steven, does maxing out the 22% bracket sound reasonable? We may lose these wonderful brackets. How about the 24% bracket?
Yeah, what Steven's talking about here is sort of the tax rate and the bracket creep, and that when you get close to the top of, say, the 22% bracket, then you may jump into the 24% bracket. I don't worry too much about the brackets when they're up to the 22%, because I think in the future they're going to be at least that high. I just don't see any way that those are going to be going down. So what I think you need to do here is you need to look at your personal brackets and say, hey, where am I going to be in 2026 or 2027? And if you think you're going to be in a high bracket, then we want to take as much of that income this year as we can. If you think, oh, I'm not going to make any money that year, maybe, I'm going to go to grad school or something, and I'm not going to have any income, then maybe we want to hold off and push that income to a future year. So you've got some timing on this because, again, it depends on what your bracket is in the year you take it out.
Okay, and similar question here. Anonymous is asking, what's the tax rate charged for Roth IRA or Roth 401k? That depends, right?
Yeah, well, if it's coming from a Roth, right, it's zero. So we know we're good on that. But if it's a traditional IRA or a traditional 401k plan, then it's going to be depends on who you are. So, Kendall and I may be the same age and the same everything else, but if we take out, different amounts or whatever, we're going to be in different tax brackets as far as the traditionals go.
Yeah. Okay. All right. I don't know if this makes sense or not, Scott. Jeff, in your last example, doesn't the 500,000 withdrawal from the IRA also eliminate the senior deduction?
Yeah, very well could on something like that. And we'd have to look at the itemized deductions to be able to maybe reclaim it back. But yes, I mean, you could be phased out of the ability to take that senior deduction, and that's a good point there. And it's like a lot of these tax credits that we see, earned income credits and different investment credits and some of the solar credits and stuff that are going away soon. But a lot of these have been income based. So if you make more than a certain amount, you either lose the credit or you lose the ability to take the entire credit. You may just get a reduced one. So that's a really good point.
Good point. All right, Devin, if you contribute 7,000 to your son's Roth from a 529 plan in his name, can you also give him the 19,000 gift per year?
Well, the $7,000 contribution would be a part of the gift. So that would be part of the $19,000 gift amount that you can give every year without filing a tax return. So if you wanted to give 19,000 plus the seven, that would be 26,000, and the person who makes the gift has to file a gift tax return. So not the person who receives it, they don't pay any tax, and the person who makes the gift probably won't pay tax, but they got to file the return anyways.
So that's a great question. Okay,
Yeah, the
thank you for
gift
explaining that.
tax returns always come into play, but I've given gifts to my kids that have been more than the annual amount, and you just file a gift tax return. It didn't cost me anything, like I didn't have to give the IRS anything, other than I had to do another return.
Oh, that's cool. Okay, very cool. All right, Terry, if you are reinvesting dividends, wouldn't they be better in a qualified account to avoid phantom income?
Well, the phantom income would come when you reinvest the dividends. You're not actually getting that in cash, but I don't think so because the if you put it into the qualified account, the reinvested dividends are still going to be taxed. Most of the companies in the U.S. at least, and any of the stocks that are traded on the New York Stock Exchange or Nasdaq fit into this, but they're taxed as qualified dividends. So Terry's right. You would be paying tax on money that you didn't get because instead of getting the money, you had it reimbursed in shares. But either way, to me, I like those into a taxable account because that 15% rate gets locked in.
Okay, great. Ramesh, Scott, sorry, can you please put up the last slide about tax-free accounts? Do you still have that one? Is that easy to find?
Yeah, it's easy to find. What was the last slide on
There you go.
this one? Okay. Yep.
And a lot of you asked about recordings. Yes, we this is recorded. It will be sent tomorrow once everything's uploaded on YouTube, and you can check it out there. We'll send you a notification, or you can check our channel tomorrow afternoon, or probably tomorrow morning. YouTube, protectwealth.com, or Protect Wealth Academy, excuse me, on YouTube. Sam, 180K W-2 income, higher payroll taxes, but max for 1K contribution trade-off. Does that make sense to you, Scott? Um,
Yeah, I'm not sure if it
okay.
would make sense to anyone else though, but Sam is asking, he's got $180,000 coming in on his W-2. He pays payroll tax on most of that, The cut this year, I think, is in 160 something or 170 something. So what he's saying there is, look, if I pay that higher payroll tax, if I max out my 401k contribution, I can take that and basically reduce the amount of wages and reduce the payroll taxes. So I think it's a good move to contribute as much on your 401k as you possibly can for two reasons. One, you can get the tax deduction today to pay lower taxes on your W-2 income. And then two, you get the tax deferral. And so you don't pay taxes on it until you pull it out. So really good question, Sam, as far as payroll taxes versus 401k contribution versus 401k distribution in the future. All of them, we've got tax considerations for sure.
Great. Thank you. I'm glad you got that one. That's perfect. Okay, Carla, should dividend paying stocks be my Roth IRA or a taxable account?
Same question here. Again,
Yeah.
all things equal, it's like we like to get the dividend 15% rate in your taxable account.
Okay, and similar, this is real estate. What is real estate income considered? Ordinary income or what?
So real estate income is considered to be passive income and it's ordinary income. So it's not considered to be earned income for purposes of putting money into a retirement plan. And so that happened. So when we're looking at real estate, I'm assuming that what the question is asking is the passive income from like a rental property or something like that. If it's active income, like I'm a real estate agent, right, and I'm selling homes or something, then that's considered to be active ordinary income.
That's very cool. Maybe a combination sometimes. That's very cool.
Yeah, yeah. A lot of times it is, depending on, you may have ordinary income that's active and passive. I have both of them every year, right? For my rental properties are passive income, but it's ordinary income. But I don't participate in it like a W-2 job or like a law practice where I would.
Very cool. All right, Scott. I'm not sure about this one. Anonymous asked, I have a DCP, which lets me convert to a Roth IRA account. My husband is 7 years older. When can we start taking out money? According to my age, we file joint.
Yeah, see, and that's a very specific question that we probably don't want to get into here. It's
Okay,
going to be depending on actuaries here and the conversions, when they're going to be taxable and what have you. So I think that's a really important area, but I think you need to go to your expert on that one, whoever is working, for you.
yeah, and then we have time for a few more questions. And Michael, I see your question here is pretty long. Maybe give us a call directly. We can help you with that. That's kind of more specific as well. Joel asks, can I day trade from a Roth IRA and will it be tax free?
Ooh, that is a really good question, and the answer is maybe. Can you day trade in a Roth IRA? Yes, absolutely, you can do that. What you have to watch out for, though, is running a business in your retirement plan. That's always going to be the problem as far as, are you an investor? Are you a trader? Are you in business here? But for the most part here, doing it in an IRA is probably going to be the best way to go about it.
Pretty cool. Yeah, you can invest, trade, buy real estate, self-directed. Don and I, Scott,
Yes.
you do this. It's kind of amazing to see the growth that happens tax-free. It's just no question the way to go, guys. Okay, let's do a few more questions. How much is tax planning to mitigate taxes on current and retirement income presently?
I'm not sure what that question means. How much
Yeah,
is it to do it? I think, for most people, if they're looking to get somebody to do tax planning for them, you're probably looking at 5, 6, 7 hours of their time. So I would talk to the professional and say, I want to have my a tax planning session here. They'll ask for your last 3 years of returns. They'll ask for your 2025 year to date and have them quote a fee for you on that. If you have a business, though, it's going to be tax deductible, at least the business tax planning would be. So I would always give people, the tax planning for business so they can get that tax deduction as opposed to the personal side, which is not tax deductible.
Okay, very cool. All right, and Dan asked a good question. Can I open a Roth if I'm retired?
Yeah, and the answer, sure, you can do it as long as you have earned income. Okay, so let's say I'm 68 years old, I retire from my job, and now I decide that I'm going to take a part-time job somewhere, or I'm going to have a small business or something that's going to produce a profit for me. I can then contribute to the Roth IRA.
Very cool. Okay, can a 401k be converted to a Roth if still employed at the same company? Oh, good question.
That is a good question, and that's a big depends on the company. The employer does not have to offer the Roth component if they don't want to. So they could just have a traditional 401k plan, but if they have a Roth plan and your employer allows it, then this certainly could be done. Up to the employer plan, though.
Okay, and this is a kind of an interesting question. Blue is asking if you ended up unemployed in the year you're unemployed. Is it the best in that year to switch to your IRA to a Roth, or is it best to do it the following year once you get another job?
That's a real good question that I guess we can end on this evening here because this is again the timing issue, right? The matching issue that so we have somebody who's been unemployed. Let's say we're unemployed most of the year. What kind of income do we have? Well, we may have a 1099 for the unemployment compensation that we get, and maybe we had a W-2 because we worked some of the year, but this would be a perfect year to do a Roth conversion because your income is going to be really low. Whereas maybe next year, January, February rolls around and now you get a job, you're going to have income for most of the year. And now, if you convert in the second year in 2026, then you may pay more taxes on that same conversion than you would in 2025 when you were in a lower tax bracket because you were unemployed. So, really good question there as far as how does your personal situation line up here where maybe you don't make much money one year, you're unemployed like this last question was, or maybe you're a student for most of the year and you don't get a job until November, so you only have a couple months on a W-2. So these are really good years for you to be looking at converting to a Roth IRA or doing something where you can pick up more income because you're in such a low tax bracket. So, you don't want to pay taxes at 37% when you can pay them at 10% or 15% or something considerably lower. So again, really, as I do these, I mean, the questions always really, really smart, really good questions from Protect Wealth students. I don't know how you get all these folks here, Kendall, but
They're
you're
thinking
magic
it
with it.
through.
Absolutely.
Yeah, and that's the same thing. You know this, Scott, very well. What separates those who are incredibly successful, wealthy, is those who are, well, asking the questions and educating themselves consistently. You hear that over and over from the Warren Buffetts of the world. What was the difference between them and the average? Dr. Danko teaches us this all the time. It's learning,
Hmm.
educating, and obviously our audience is here tonight, so you're obviously doing that. But I will say, Scott, as you know, education only goes so far. Eventually, you have to take action, and work with the experts because you don't know everything. As you can tell, Scott can answer and cut through a lot of those questions pretty quick. So it's always worthwhile to attend something like the summit. I just posted the link there, and work with the experts, education, and work with the experts like yourself, Scott. Seriously, Scott, thank you again so much. What a great webinar. I learned a ton myself. Thank you very much, and it's hopefully going to help us all be better planners. We appreciate it, Scott. Everyone, thank you so much for coming. Scott, tell your family hello from us. Everyone, have a great night. We look forward to seeing you at another summit soon.